Okay, good afternoon. Welcome back, everyone, to our Thursday afternoon session. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay, and I'm joined here with Jessica Inskip, Director of Education and Product. And today we're here to do a fairly new session here, which is Trading the Markets with Tony and Jess. Really going after talking about the current markets. We've had a lot of volatility over the past few months, a lot of volatility over the past few days, and we're going to really break down what's currently happening in the markets and how we are trading it, and just giving you a brief overview of some of the important economic events that we are looking at from a trading perspective and how we are viewing the markets and looking for opportunities in the current market conditions. So Jess, welcome, and thank you so much for joining this afternoon.
Yeah, thanks for having me as always, Tony. We have a lot of discussions about that, so excited to go through this with you guys. So let's go through the lineup and what it looks like. We're going to go through this week in the market, and we're going to work on having this as a cadence as well. So we'd love to keep this interactive. So questions throughout or comments would certainly be very, very helpful. But we'll talk about the Fed speak, key levels, what happened there. We also did some analysis on the market as a whole and what happens in those type of environments and high inflation environments, and just so we can understand that together. We'll talk about bear markets and some technical analysis. We did a survey a while ago that I think a lot of you participated in, and one of the loud resounding themes was additional education on technical analysis. So we're going to incorporate that today in addition to our normal options education. So that's going to be here as well. And then we'll have some trade ideas. So Tony and I are going to give trade ideas. We'll debate them. We've got some thoughts on them together that we're going to share with you and how we would look at that process, but utilizing the tool throughout with every step of the lineup. So without further ado, let's go into this week in the market.
Yeah, so this is going to be an interactive session, so please have your comments and questions coming in the chat window. We'll try to address them as much as possible live. We will do a small Q&A here at the very end, but really today we're trying to keep things as interactive as possible. So keep your questions streaming in as we go along. And I do think that perhaps this is a good time just to launch a quick poll here before we get started. I want to get a sense for the audience because there is a lot of uncertainty in the markets. Where do you see equity markets in 1 week's time? Higher, lower, or perhaps you don't know. We're going to do these polls fairly often going forward to give you a sense for how everyone else is currently thinking on the markets. Right now, it seems that the fairly large consensus is that 2/3 of you say that you think equity markets will be lower 1 week from today. Only 12% of you say that you think markets are going to move higher. And we're going to talk about some of trading, about market psychology a little bit today and kind of how that influences the market as well. But 23% of you say you don't know, 2/3 of you say lower, and only 11% of you say you think the markets are going to bounce and move higher. So very interesting results, not surprising, but very interesting. And I think that we'll discuss kind of how that potentially weighs into the decision-making process for finding either bullish or bearish opportunities here in this market.
Mm-hmm. All right, so let's talk about what happened. So I'm calling this economic calendar highlights because we didn't pull everything on the economic calendar, but since really the main concern with the market is inflation, and then the FOMC raising interest rates as part of their monetary policy in order to battle inflation to get to their target rate, it's important to highlight the economic calendar, just pieces of it or components that contribute to that decision-making process. And I'm pulling it just going back a couple of days, and then what's actually happened today as well. So really the big one was last Friday when CPI came out. I put all the stats on the screen, but essentially, just like with earnings, if it's something you haven't looked at before, there's a consensus that comes out. And if the actual is less or more than the consensus, then the market is going to react. And that's what happened. We had higher inflation from the CPI data. So that's giving us an indication that the baskets of goods are higher and higher. And then that's broken down, and we'll actually go into the charts and what's comprised of and what's contributing to that push up in CPI. So it was actually 1% and the consensus was 0.7%. That's the takeaway from that. And then additionally, so that was pre-market, that adjusted the futures. And then at 10 a.m., the consumer sentiment came out. And so just like when we gave you that poll, it's a more of an in-depth poll. And there's a sentiment gauge of understanding people's feelings on the market and really on the economy as a whole. And if that's low, then that can also push the market down as well, because that's somewhat a gauge of the health of the economy. And then comes Wednesday, the Fed, as I'm sure everyone is fully aware of, raised 0.75 bips. And that was the largest hike in a very, very long time in response to the CPI data. And they also indicated their forward-looking indicator as well. And then the market reacted actually pretty well to that upon initial response. But then Powell started talking about the reasons behind inflation, which we'll get into in a moment. And then there was actually overseas announcements from the Bank of Europe, where they also raised more than anticipated, which again, then caused our markets to really go down. So those are the things that we're looking at, and probably a little bit too much detail there. But then this morning, jobless claims came out, and that's important to highlight as well as a contribution to inflation, because it's a hot labor market. And that's something Powell spoke to, is we have record low unemployment, but because there is a hot labor market, it's requiring a lot of job openings in order to attract workers into different positions. Companies are having to raise wages, and when they're raising wages to attract those workers, that can really push up expenses, which is then passed on to the product. So that's a trickling effect. So that's why it's important to look at jobless claims. That needs to be seen. A lot of analysts are saying needs to cool off a little bit, and that's something that Powell actually spoke to when he gave his speech after he announced his rate hike. So those are what we were looking at. The actual came in less. I apologize, I didn't add that to the screen, but these are the important factors that we'll be looking at going forward, just to understand the inflationary environment and how the Fed's going to react. And then we'll talk about how this equates to technical analysis and how you look at the market. The basics of technical analysis is that the market's forward-looking and consumes news as it happens and then adjusts accordingly. So we want to know when those news events are, so we can make our adjustments, but also understand when there is extreme moments of volatility, when that would be exacerbated, which would be around these economic events.
Yeah, and as technicians, many times we say we're not in the business of why, we're in the business of what, meaning there's a fair amount of work that can be done to digest these types of numbers and understand kind of what all of these numbers mean from an economics perspective. But as a technician, that doesn't matter so much. What matters more so is how do the markets react to this type of news? There's no such thing as really good news or bad news. It's just news. And the question is really, how do markets react? And that's really where we use the chart's technical analysis to get a gauge of where markets are. And I think this is probably a good time for us to take a look at, the broader equity markets and kind of where they currently sit here at the moment. And I'll just share my screen real quick to show some of that. And Jess has a few charts that she wants to show as well. This is the chart of the weekly S&P 500. We have a Ichimoku cloud here. And what's really interesting is the fact that we traded up towards the cloud here a few weeks ago and was rejected here at this cloud bottom here a few weeks ago. And now we've traded substantially lower. And the one thing that we still have is one more day left in this weekly candle. So it's interesting to see whether or not we see a bit of a bounce here after a bit of a flush today. Today does feel a bit like a bit of a flush, some capitulation here to the downside. So we'll see kind of where markets react tomorrow, but it's possible the last possible remaining, I would say, potential case for a bounce here is really kind of this lagging line here against the weekly cloud. Now, as of today's close, it is below the cloud. We might see tomorrow's close maybe bounce a little higher and see this actually hold this cloud. And perhaps that is a justification for a bit of a small bounce. But largely, I think overall, this is very much in a bear market. The fact that we were rejected here at the top of the cloud is certainly very bearish. And from my perspective, even if we do see a bounce here over the next couple of weeks, the larger picture here is still a very bearish market. So, overall, from a broader equities perspective, I think, especially with some of the metrics and data points that we look at, it certainly points to some extreme bearishness here right now. And that, generally speaking, as a contrarian indicator, leads to some small bounces and potentially some moves higher. So I know someone else asked, what's my answer to the poll? I think in a week's time, we could see markets a little bit higher. But again, longer term, I still think we are clearly in a bearish market. And I don't think that is going to change anytime soon.
Mm-hmm.
Hey everyone, I hope you've been enjoying the session so far. I would love for you to join me for the next live education event where you can learn alongside thousands of traders and I'll answer your questions. Click the link on your screen or check out the link in the description below. For our OptionsPlay members, I host weekly trading education sessions just like this one, and you'll get to trade alongside our research team's daily trading signals, weekly technical research, and gain access to our options strategies analytics platform. Sign up for a trial and try us out for free for 30 days. We're here to help you succeed, and please make sure you like this video and hit the subscribe button. Thanks everyone, and let's get back to it.
All right. I'm going to steal the controls back from you, Tony. And I do see a question on the triple witching tomorrow. That is tomorrow. That just simply means that there's stock expiration, index expiration, future expiration, all the expirations are all on one day. So that usually is indicative of a lot more activity within the market. If there's one specific strike price though, sometimes there's pegging that the market maker will do. So it shouldn't be too much of an impact though. But curious of your thoughts on that, Tony. We've never really talked about that before.
Yeah, there's been quite a bit of statistical analysis on this front as to whether or not there is truly higher volatility on triple witching or even quadruple witching. And the data clearly shows that actually volatility on those days is actually slightly lower than average. So from my perspective, just because you're going into a triple or even quadruple witching hour doesn't really change much from a volatility perspective. But as Jess said, generally speaking, we do see some pegging of kind of where the strikes, where the market ends based on where the highest amount of open interest tends to be. So if you look at SPX, you look at NDX, you look at where the open interest is, we tend to see a bit of pegging, meaning or pinning, if you will, of the index near those high open interest strikes at tomorrow's close.
Great question. So CPI, we pulled some charts, and these are from the Bureau of Labor Statistics. So it's something that you can pull, and they're actually interactive and go through them and find them very interesting. But the reason why we wanted to pull this is one, it's the main contributor to that downturn from Friday. So I think it's important to look at that. But it's interesting to see the 12-month percentage change in the CPI and how it's gone up, and then how it gets above 5 here for this gray shaded area indicates a recessionary period. So here's our major recessionary period, and here's another one right here. The main contributor though to the CPI is energy. And so that really equates to what we've seen overall in the market from a sector perspective, because energy has been one of the best performing sectors thus far. And we'll talk about that in a little bit, but that's largely due to the things that are out of the Fed's control, which is they can only control demand, not supply. So since there is a supply constraints or commodity shocks due to the Russia-Ukraine war, that definitely equates to higher energy costs and things of that nature. So it's something to pay attention to, is not only we have really record high inflation, but what's the main contributor to that record high inflation? What can monetary policy do to actually battle that? And remember, monetary policy, what the FOMC handles, is purely on demand, not supply. And so those are just interesting things to be aware of, and a lot of debate and talk is certainly around that.
Yeah, and I certainly think that that's sort of the debate as to whether or not, 75 basis point hike this meeting and potentially another 75 basis point next meeting is the right strategy, considering the fact that there are quite a few elements here that are outside of the Fed's control. If this was a more normal, I would say, time where we're not coming out of a pandemic and supply chain issues and a war that the Fed can't control, then perhaps that 75 basis point move this month and potentially next month could be the right move to battle inflation. But perhaps they might be even hiking a little bit too much because of the fact that some of these things that are causing the inflation is out of the Fed's control. So that certainly is, I would say, the active debate here right now. And I think that the market's reaction today is, perhaps a little bit indicative of how the markets are viewing, the Fed's policy from yesterday. Clearly not seeing it as enough or perhaps not as the right strategy per se for equities to find a bit of a bottom. There's a lot of questions in the chat window here about kind of discussions about how do you define a bottom? How do you determine how long this bear market lasts for? And that's a really good question. It's a really difficult question to answer. I will say, some of the classic indicators that we typically look for are really volatility to come down as equities continue to fall off. And we actually saw some of that here today because VIX did not really move materially higher today from the last few days, but equities are materially lower from where they were a few days ago. So, the fact that we've seen substantial downside here in equities over the last few days, but volatility has not increased, is actually, a promising indicator for potentially at least a short-term market bottom. We also saw put-call ratios peak today, again, well above 1.91% today, put-call ratio. The other thing we also take a look at, and we'll talk about this in a few minutes, is really just the overall bearishness of the market. 2/3 of you, or the number of viewers here today that think markets are going to end up lower versus higher outpaces, almost 5-1 or 6-1 almost here. So the fact that for every 6 investors that think the market's going to move lower, only 1 investor thinks that market's going to move higher. When things move to those types of extremes, those are also potentially, where we see market bottoms. When there's no more buyers, that's really where the true market bottom tends to be. So those are some of the things that we typically look at to help identify whether or not we are near a market bottom. I don't particularly think that we're just there yet, but, at least in the short run, I think that this could lead to some short-term bounces, if you will, over the next week or so.
Just a view of what happened on a day-to-day basis. So this moves into when we actually officially went into a bear market. And this is something I speak to quite a bit. And if you actually pull a weekly interval over even a 20-year period, and you have that 20 weekly moving average or 20 period weekly moving average, you can see that mean reversion happen. It sometimes goes right below it, like it does here. So this is the 20 weekly moving average. The pandemic lows, we went below it, went right back up, and then we were back into a bull market. So technically, and definition-wise, you're in a secular bull market when you are above this line. That's long-term. But if we're looking at a bear market, that's the short-term, and that's what's defined now by the terms of a bull market as the S&P 500 has gone down 20%. And then we'll talk about looking at broader views versus narrower views when we go into the Farell rules that we highlighted earlier. But the point of this is just showing you the mean reversion. This is the line indicating that 20% decline, putting us into bear market territory. We'll talk about that as how to analyze that, and the rules that are really old technical rules have been around for a while that technicians utilize and a lot of people utilize when they're trying to understand bear markets and the technical aspects of it. Before we do that, Tony, do you want to talk about sectors a little bit?
Yeah, I definitely want to take a look at some of the sectors. So let's jump over here to OptionsPlay. And right now, I think that despite the fact that we see a fairly strong bear market here, the question still is, within that bear market, where is the opportunity to position either for a bounce, for those of you that are in that camp of of seeing some upside here for some stocks, or for further downside here in the equity markets? Where do you find those opportunities? And that's really where I think breaking down into the sectors is a good place to start. And you can use the watch list feature within OptionsPlay. There is a watch list called Sector Spiders, where you have the 11 sector spiders that are available for analysis. And if you sort this watch list based on the relative strength, what you get is effectively a sorting of the sectors from the weakest sector to the strongest sector. So it's not, I would say, surprising to see communications, discretionary, and technology at the bottom. These are some of the worst performing sectors in this market. And then staples, utilities, and energy at the top, at the top of the list with the highest relative strength, because those are the best performing sectors. And there's a few notable ones that I think I want to point out here. First of all, just overall, looking for bearish opportunities, looking within these three sectors is usually a good starting point for further downside. Whether you're looking for some of the names in communications, most of the retailers and discretionary stocks, I definitely would stay away from, and I still see some fair amount of downside in those particular names. Technology, I think there's still plenty of downside here. I brought up one here on CNBC last week, Match. Certainly a technology player that still trades at very elevated valuations, further downside. So as you're looking for opportunities, looking within the sectors and understanding which sectors are strongest and which sectors are weakest helps provide a bit of an edge in terms of which types of stocks will see further declines or declines faster. And as you can see, energy, discretionary, tech, down nearly 4% here today versus some of the best performing sectors. Staples and utilities down only 0.75%, only 2%. Healthcare also, Jess, you've been a big advocate of healthcare throughout this decline. Seeing some protection here, down only 1.5%, while the market's down 3-4%. But the one sector that I do want to point out and kind of make a note to is financials. We've seen the yield curve invert. We've seen the yield curve flat. And especially, the specific banks that have a high amount of income based on interest margin, such as, Bank of America, Wells Fargo, these types of major banks, those are the ones that are most sensitive to this interest rate environment that we're in and actually see some substantial downside. So, financials, if you look at the cloud model here, just recently broke below the cloud. And I really see this as the start of what could be some further downside here for financials. And there's a lot of, I would say, analysts that are currently saying financials are cheap. Now is the time to buy. And this is really where I think that this is the wrong view at the moment. I think valuations completely go out the door in this type of market. You don't see a lot of value investors stepping in this type of extreme volatility and bear markets. So I think that financials is one that remained fairly sideways, fairly neutral here over the past few months, but I see some further downside in this inflationary, recessionary, yield curve flattening environment at the moment. And then just in terms of opportunities, I still think, as Jess, you've been pounding the table with respect to healthcare. I also think staples and utilities are two places that you're going to find a little bit of safety here. May not necessarily be stocks that will move higher in a bearish market, but certainly stocks that will not move down as much, and also provides a fair amount of yield in those types of names versus, some of the more discretionary and technology names that have driven the market over the past, call it, decade. And lastly, energy. Where is energy headed going forward? From my perspective, I don't think this decline here is by any means the end of energy as a sector. I still believe that energy, especially if you look at the cash flows that are being generated by these companies, when oil's trading at $120, is extremely strong from a free cash flow perspective. And you're going to see these companies not necessarily reinvest this into more oil and gas exploration. I think you're going to see a lot of these companies return cash to shareholders through the form of dividends, the form of buybacks. And I think that, if you look at the bigger picture here, this is the weekly cloud model. We've only pulled back to the top of the conversion line. We can potentially pull back to the baseline here, but I think both these are potential further opportunities for further downside, further upside here in energy. So that's a quick review here of the individual sectors, and I think that there are plenty of opportunities on both sides. It's just a matter of understanding, the strength of each sector, and you can do that using this watch list feature here in OptionsPlay to quickly sort through which sectors are performing, which sectors are underperforming, to understand how you find opportunities.
Mm-hmm. I know I was taught years ago utilizing the utility sector as an indicator because it was a safe haven. I remember back in 2009, so where I was first learning a bit of technical analysis, where I was taught just to look at that, and if there is a huge influx in that, and when that starts overperforming, that's when, even on a daily basis, that's when people are getting scared, when you see an inflow into the utility sector because it is a safe haven. And then if you think about demand and the strength of the consumer, that's something that you have to make sure that you have as your electricity. So it's certainly interesting from where the strength is, but also a view for the health of the consumer and where the market's headed overall.
Right, and we just saw the utilities get back to the top of the cloud on the weekly chart, and intraday, or intra-week rather, bounce, and so far holding the top of the cloud. So I certainly think that from a defensive perspective, if you're looking for opportunities, my preference would be looking for opportunities in names like utilities rather than some of the other names. Quite a few questions here regarding opportunities here in this market, and I think that this is probably one of the more difficult markets to trade. And the reason I say that is because obviously I think that a lot of people have bearish views, but despite those bearish views, I think it's very difficult to push new shorts in this type of environment. We're talking about, a market that's been down nearly 10% here in the past week or so. We're talking about 25% here in the past few months. How do you push new shorts in this particular market? And I certainly think that from a statistical perspective, it favors the upside at the moment. When things are this oversold, when you see a fair amount of capitulation, statistically speaking, you're better off taking some longs. And that's why we continue to try to scalp some longs here, arguably some unsuccessfully, but statistically speaking, it's not a great time to push new shorts when markets are this extreme to the downside. So that, from my perspective, is really kind of the difficulty with trading this current market that we're in.
Mm-hmm. And I see a lot of comments on the Dow theory. I love the Dow theory. And I've always wondered, so I think the theory that we're referencing now is the transports versus industrials. And the rule is if one hits a higher high, so should the other. And if you look for divergence, then that could indicate bearish trends or changes and things like that. The Dow theory is really great with the fundamentals and basics of technical analysis, but that's certainly not the case anymore, because looking at just industrials or the transportation index is not really a correct depiction of the market. So it'd be interesting if you would apply that same mechanism with perhaps technology or something like that, that would make it a little more with the time. So I think some analysis could certainly go into that, but that's a great comment.
Absolutely.
All right, so that is a good transition into, I'm just going to call them out. Actually, the Farell rules that we were talking about, or I can bring them on the screen as well if you want. I don't want to go through every single one of them, just because there are 10 and not necessarily all of them are applicable right now. But just like the Dow theory, I believe that one was in the 30s. The Farell rules is a technician around the 60s, and it's still applicable today just when looking at technical analysis. He used to work actually at Merrill and retired, I think, about 20 years ago. But let me go ahead and share my screen. All right, so these are the Farell rules, and just the ones that I want to call out, which really speak to everything that we've been saying. Markets tend to return to the mean over the time. So a lot of even the cloud-based model, when we're looking at the moving averages, or a lot of the indicators are involve some type of calculation that are inclusive of mean reversion when you are trying to define your support and resistance levels. So those are just stays true. It's been around for a while, and that is true with the way that we look at the markets.
I do want to be a bit of a devil's advocate on this front. While when you look at the moving averages, we always see price returning back to the average, especially after an extreme move. I do want to point out the fact that the moving average is a moving target, right? So
that's true.
So while I don't necessarily agree that markets tend to return to the mean over time from a price perspective, because and we can pull up any long-term moving average, and what you see is that after a big change in trend, that moving average is moving all the time, right? So you're actually not returning necessarily back to the mean, at least from a price perspective. But if you plot equities from a valuations perspective, they do absolutely return to the mean over time. And that, I think, is probably more meaningful in my opinion. So while I completely agree with the concept, I don't necessarily agree that they always return back to the mean from a price perspective, because if let's say, let's just pull up some real numbers here. Let's not go back and forth. Let's look at the 200. Let's say, for example, the 200-week moving average on the S&P 500. Right now is at 350, right? But let's just say at the beginning of the pandemic, that was 263. So if when the
share your screen time.
Okay, sorry. My point is, if let's say the market made this extreme move here to the upside, and your expectation is that market's going to return back to its mean, at that time, the mean was 276, right? So if you took a short here expecting the market to return back to 276, the reality is that that's not going to happen. And it actually took quite a few months, where it kind of returned back to the 350 level. Perhaps it reaches 350. But, at that point, you basically entered a short at 350, and you, first of all, took on a ton of pain as the market moved higher here before it kind of came back, and you're at best at break even. And that doesn't even account for, the transaction costs or the carrying costs to take a short position over that period of time. So I'm not a big fan of this idea that price reverts back to mean from an absolute perspective. But if you look at things like valuations, you look at price to earnings ratios, those are mean reverting, true mean reversion. And if you look at also volatility is a good example of a true mean reversion, right? This is the mean, but as you can see, the 200-week moving average of the VIX does not change very much over time. And when you have extreme moves to the upside, you tend to get a quick move back to reversion fairly quickly. And these are actually, much better trading opportunities. So I agree with the sentiment. I think it's important to understand the application of it, that, absolute price, not a huge fan of it, but from a valuations perspective, from a volatility perspective, from a currency perspective, those are more mean reverting asset classes. Even interest rates, interest rates are far more mean reverting than equity asset prices per se.
Sure. I can agree with that as on an absolute basis, but I still think maybe I interpret it differently. So if you have, because things are added to the calculation, it is going up, but it's just, if something moves too far too fast in either direction, then it accounts for that. And even though it is moving and it moves with it, I agree with that. But at some point, it intersects at bottoms, and that's happened throughout history. But I agree. Yeah. Okay. Glad we had that conversation live.
That's what this is for.
That's true. Elaine brought up a great question on shorting the VIX. That's with options, and I think I've been doing that quite a bit lately. Anytime I see volatility spike, I'd sell a credit call spread on it, to be honest. I personally don't like doing naked calls just because of the unlimited risk associated with it. So I will always cap my risk with a credit call spread, and it requires a ton of margin normally. So a credit call spread's a great way to do it. But you can trade you can't trade the index directly, but you can with an option. So you definitely would utilize options for that.
Yeah, you can either trade the option, which is my choice of vehicle. You can also technically short the VIX futures, but just know that VIX futures can deviate quite far from spot VIX, versus when you trade the index option, you are actually trading spot VIX.
Mm-hmm. All right. Let's see. There were a couple more Farells. I'm just going to point out two more, and then we can go on to our trades and talk about that. All right, so this is the one I wanted to highlight, which was bear markets. Bear markets have three stages: sharp down, reflexive rebound, and a drawn out fundamental trend. This one, I want to back test and take a look at the overall market just to completely understand. But this is something that's I've seen highlighted quite a bit in analyst reports lately. I've seen a lot of people who do charting start highlighting these rules, and it's an old school rule like the Dow theory. So I think they definitely have some value associated with them. So there's some importance with that. But it is interesting, and it alludes to the fact that when you're in a bear market, there is that sharp downturn that we've experienced. But the reflex rebound, there's those relief rallies or those relief bear rallies that we experience that's drawn out by a fundamental downtrend before we actually have that rebound. And then this is the last one, excuse me, that I do want to call out, is when all the experts and forecast agree something else is going to happen. And that's that contrarian view that is essential and important. If everyone throws in the towel and say, yep, we're all sellers, it's done, well, then the sellers are gone. That's literally the definition of capitulation. So that's when it's interesting how markets react, or when they'll adjust and when they will move accordingly. Anything else you want to call out on that one, Tony?
Yeah, I mean, the bear market's in three stages. There's another, for those of you that are technicians, Elliott wave is another way of kind of thinking about that, or rather charting that. And the question is where we are in that particular stage right now. I would say that we are still in a bit of a sharp down move. I don't think we've really seen a true reflexive rebound yet. And I certainly don't think we're currently in the drawn out fundamental downtrend here either. Usually those types of moves happen below the 200-day moving average, a 200-week moving average, which we have not seen just yet. So, I do think that you're going to find some support in the markets here between where we are now and where the 200-week moving average. So that's, about 3,500, 3,600 on the S&P. I do think that markets are likely going to find some area of support in this range, and probably see a bit of a bounce here. And on that bounce is where some traders are going to say, okay, we've gotten the bounce, let's get back in, only for the markets to kind of continue to push lower. And I really think that you're going to see a push below the 200-week moving average before you truly flush out all the hands here, and can see a true market bottom.
All right, so real quick, actually, I will pull this one up. We did want to point out a user question. So, and this is something new we're going to try, so would love some feedback on this as well. But we have a wonderful customer service team, and anytime you message them, they'll answer your questions. And a lot of time it's Tony and I answering them directly, or Prakash or other people from the team. So we want to just highlight some that we could find a little more broadly. We didn't want to answer this one directly, but thank you, Steve, so much for sending this question. But a lot of what was formulated around this presentation was this question. So we just wanted to highlight that as far as where do you see things through the end of the year? And we didn't talk about timing, but perhaps we can. But finding support levels and understanding technical analysis will certainly help to define your price targets that you're defining for the security. And it's really a lot of what the OptionsPlay tools were built around to help ease that process. Anything you want to add to that one?
I think that these are great questions to ask, but I will say that I think it's a bit of a futile thing to try to answer some of these questions, just because, no one really trades for the end of the year. We all trade for what's going to happen tomorrow, next week, and maybe next month. I don't think most people are trading for the end of the year. So And I think a lot is going to happen between now and the end of the year, meaning a lot more ups and downs. And it's, from my perspective, I'm trading those ups and downs rather than where I think the market's going to end at the end of the year. But these are great questions to ask. And like I said, I think most of the stocks that you're asking here are very highly correlated. So I think if you just answer one, you sort of answer all of them. And hopefully my response right before just put this up in terms of my views on the S&P 500 provide you with some insights into how I'm thinking about this.
Completely agree. I think the only time you do trade at the end of the year is for tax purposes. That's it. All right. So we did want to highlight, just so we can make sure that we account for that options education that we share with you, and then we'll go through some trades, but we'll just cover this very, very briefly. Just two of the options trades that are bearish that you would see on the daily plays quite often would be a debit put spread and a bear call spread. We mentioned a bear call spread earlier when shorting the VIX. So let's talk about a debit put spread, which is something I would never do on the VIX. I want to just make that clear. All it is the driver is a long put. So this is a bearish view. And remember, it's a directional play. So when you're buying a put, you want the stock to go down or the underlying security as much as possible. You want that velocity. So this type of environment, if you feel there's more room left for the downward side, then a long put is definitely something that you could do. Remember, you are buying time, like anytime you're a long option. So you do need the underlying security to move more than the time that's paid. And that's the premium right here, but it's a directional play. And as the stock goes down, so does your gain potential. A debit put spread is simply capping that gain potential, and you pay less for the strategy. That's simply all it is. So instead of, on this case, if we buy the 150 strike, if ABC were to go all the way to 0, we could capitalize on that by creating a debit put spread. We just stop our gain potential if ABC was to go to 140. And this is a trade that you would see on the daily plays quite a bit. So we want to make sure we highlight that from an educational perspective, and then we'll give you a couple trades that we would do on that right now. And then the last one is the short call spread. So this is the bearish side. And if you remember that T-chart in the quadrant that we display quite a bit, these are the both that are on that bearish side of the T-chart. And the drivers are the short call and the long put. And these are just extensions of them. A short call does have unlimited risk. And that's why I definitely prefer not to have a naked position with a short call. You can cover it by owning an offsetting long position, which could be an underlying security with something like volatility or the VIX. You cannot obviously buy that to offset your position, but what you can do is purchase a long call option that is an offsetting position that contains the right to buy something that will cover the position. Volatility is interesting though. It has to be the same expiration date. Otherwise it completely adjusts and it's considered naked at that point. So that's important to note. And that's because it's a different look at volatility. Anything you want to add to that, Tony? I know I really breezed through that.
Yeah, I think the best way to kind of really solidify what you just showed us is really looking through some examples, right? So I think there were quite a few questions from viewers asking, how do you trade this type of environment? And I think that using a combination of debit and credit spreads when you have a directional view is largely how you're going to do that. So I think the best thing to do is look at some of these examples and talk through kind of why we would use a debit spread in certain scenarios, why we'd use credit spreads in other scenarios. So looking for opportunities in this market. As I was saying before, when we look at the sector spiders, if you're looking for bearish opportunities, communications, discretionary technology are definitely obvious places to look. So one of the things I do want to show you is a new watch list feature that we've recently launched to provide far more screening ideas for you. Whether you're a fundamental trader, we have cheap valuation and strong growth fundamental scans. We have income-based scans for those of you that sell cover calls, cash secured puts, straddles, and strangles. Our top choices from a yield perspective for any of those strategies. You have upcoming earnings, you have unusual volume, but two of the watch lists that I want to show you is the momentum bullish and the momentum bearish watch list that we recently created. This really looks for quite a few different things to align from a momentum perspective to give us, stocks that are trending in a specific direction and have strong momentum in one direction. And a specific name that came to mind here was Starbucks, because it's in the discretionary space. It has underperformed the broader markets. And clearly, as you can see, relative strength is poor. Trends are poor, very similar to many other stocks in this particular camp. But Starbucks, for me, on the discretionary side, especially since this recent move here we've seen back up to the $80 level was rejected, for me, leads me to believe that there's further downside here in a name like Starbucks. And the question is, how do you press new shorts in this type of market environment? Now, the one thing that we typically look at is you can look at IV rank to get a sense for what type of strategy might be suitable. So the fact that Starbucks is an IV rank of 77% leads me to first look at high implied volatility strategies. So looking at credit spreads, looking at selling premium, because when volatility is high, you're going to have an edge from selling premium. So what we're looking at here is the July 29th, 71.78 call vertical here. And if you look at what the price of this is, you're going to be able to collect $2.72 while risking only $4.28. So you're collecting a fairly large percentage of the spread. So $2.72 on a $7 wide credit spread is a 38.8% of the vertical width. So the OptionsPlay platform helps you identify the opportunities, helps you understand what type of option strategy might be suitable for you, and then picks the expiration dates and strike prices and optimizes that all for you so that you can simply click on the trade button and see the details to enter this trade into your broker's platform, or you can paper trade this. If you're brand new to these types of strategies and you're just learning, add these positions to your paper trading portfolio under the trade tab. And then you can track these positions in your portfolio here within OptionsPlay to learn more. Now, for those of you that want to learn more about credit spreads, I have a whole lot of education that you can watch separately on our YouTube channel. But this is a good starting point to help you find opportunities. These new watch lists that we've created, the bearish and bullish watch lists are a great place to start when you're looking for bullish or bearish opportunities from a momentum perspective. And then looking at the chart, looking at the IV rank helps you determine perhaps where you might want to do your research. And, Jess, this is really kind of where I would start. I'd love to hear your views as to, your views on Starbucks and kind of what you might change about the strategy itself and kind of different views that you have on how to structure this trade.
Yeah, Starbucks is actually something I am bullish on. I think in the short term from the overall market, bearish, and I like this trade, and I think it would perform well because of the overall market. But going into I really read a lot, which is a good and bad thing, I suppose. But looking at the way Starbucks has really positioned itself with that tight labor market, and that's what I think is really interesting about this inflationary interest environment. It's record low employment, and that's contributing to it. So if there is a hot labor market, it's important to think about how companies are going to be impacted by that. And Starbucks, from a management perspective, pre-COVID was really ahead of the curve and raised their wages exceedingly so. So if that pressure is still there, they've already accounted for it in their profit margins. Now, if there is weaker consumer demand and the first thing people cut is their coffee, then I am incredibly wrong, and that is the risk to it. But looking at a fundamental perspective, I'm bullish on it because of the way that they positioned themselves pre-pandemic. I think short term, that is the right trade. I'm thinking more long term on the way I feel about it.
So how would you structure that? Would you be selling a put spread? Would you be buying the stock? Would you be buying a debit spread? How would you structure that, and why?
Yeah, if it's long term, I love the wheel strategy. I use the wheel strategy anytime I want to buy a security. So even though it's a bearish market, and I feel like I did read this really great report on securities that performed really well throughout recessionary periods where they had positive earnings per share, where they had positive revenue, and that was growing. Looking what the security was pre-recession, during recession, and post-recession, even though that they were growing and fundamentally extremely healthy, they still went down in value. So what that means is that's an opportunity. I don't know when we're going to call the low, and I think that's impossible to call the lowest lows. But in bear markets, if you were to buy really healthy securities, you made up really, really well, because when they rally, they rally. So I would definitely sell some puts. I would be very cognizant of my strike prices, and I'd probably buy it and just sell covered calls, reducing my cost basis constantly if it's something that I want to own, which I do like Starbucks.
I will say that that is a ballsy pick
to
sell puts in this market. But I will say, you're earning 2 points. I just pulled, for example, a short-term aggressive put option, right? This is what you can use the income tab here for OptionsPlay to help you quickly select expiration dates and strike prices for these types of strategies. So when I go to income for credit spreads, for Starbucks, and I select that I do not own shares of Starbucks, it's going to provide me with the put option to sell. Now, I had originally selected longer term puts to sell, but I think in this type of environment, you could sell shorter dated puts. I saw a question here before, why not sell shorter dated options in this type of market environment? I tend to agree. So looking at the July $68 put option is a good place to start. That's going to collect $154 with a max risk of $6,646. That's assuming the stock goes to zero. And if you're selling a cash secured put, that's the cash that you need to set aside in order to sell this put. And you're going to collect $154 on the back of that. That's 2% of the stock's value, a little bit over 2% in just 3 weeks. That's not a bad return to collect 2% in 3 weeks, considering the stock itself pays just about 2% in a full year that you own the stock. So you're collecting 2.5% owning the stock in dividends. You're collecting 2% in 3 weeks' time selling the put option. That annualizes out to 36%. That is a pretty resounding yield on your cash, presuming that Starbucks stays where it is, maybe moves a little higher, but you're comfortable owning the stock at $68. It's a very, very different view as to how I'm playing Starbucks, but I'm glad we're having this conversation because that's what makes a market. And I think that's is the discussion that we're here to have, is how do you position for this type of market?
Yeah.
And Jess, I think you have a bit of another trade that you want to take a look at here. On the bullish side, how do you pick opportunities in this market? And I certainly think we agree, at least on the directional view on this particular stock, but what's your stock pick here?
Yeah, when Tony and I were discussing this, we ironically both had Starbucks and Dollar General. So that was interesting that out of all the stock universe, we chose the same securities. But Dollar General, I think is a great pick. It's something I believe I went on CNBC and talked about that one as well. Just essentially when Target and Walmart were offloading all of their excess inventory, this is something that security could benefit from. 80% of their revenue is from consumables. And so that's two factors there. One, if there's excess inventory, discount retailers like this can benefit from that excess inventory. It's something that can help them. Two, when there is a high interest rate environment and there are those consumers in the low income bracket or in general going to a lower discount security that's primary revenue is based off of consumables, they could see an influx in revenue because of the need for that in a discount retailer. So I'm bullish from that perspective. Also, the chart is really beautiful. It looks like it's going to break out. So this one is a bull call spread for me.
So one, I will agree with you on the directional view. I think we are clear that these discount retailers are the place to be in this type of recessionary environment that we're heading into. We certainly know that, from consumer spending perspective, there's been a pretty drastic shift away from kind of more discretionary luxury type spending to more of these discount retailers. We've seen that from the Bank of America credit card data. And just if you look at the numbers, right, this is I found Dollar General through the bullish momentum watch list that we have here. There's only 11 symbols in there. It's a pretty small list at the moment, but Dollar General is one of them, and it has a relative strength of 9 out of 10. So it's outperforming the broader markets. It's one of the few stocks that have both bullish and trends for both short-term and long-term. So everything from a technical perspective certainly tends to agree. And I do see this, 230, 240 level here as a potential breakout level. If you do see a breakout, hasn't broken out yet, but that's the potential. I think the upside target here is into that 260 range. And if you look at the vertical spread here, and one thing I will point out, the IV rank here is 42%. So Options are elevated, but not super expensive here. But I still think because they're somewhat elevated, it makes sense to use a spread. So I also happen to agree with you here on using a debit spread. The 230-260 call spread here is 1,095. I do want to make one suggestion here because we're in a bear market, because this is a stock that's trading near the upper bound of its range. It's also relatively, on the expensive side from a valuations perspective. My preference is to reduce our risk a little bit even further by looking at a 240-260 call spread. So as you can see here, the 230-260 will cost roughly $1,100. The 240-260 will only cost $600. So I'm reducing my risk here by more than a third by using that 240-260 call spread. So slightly out of the money. It's really more of a waiting for a breakout play, and if it does, I have a really nice more than 2-to-1 risk to reward ratio because my max reward is $1,400 while I'm risking only $600. Here, my max reward is $1,900, but I'm risking $1,100. So the risk to reward there, from my perspective, I don't know you're going to get a breakout, but if you do get a breakout, I'd like to get paid more than 2-to-1 on that trade. So that's why my vote is to use something like this, a 240-260 call spread on a name like Dollar General. This gives me 64 days to see this potential breakout here on this move. And I do think that this is one of those names similar to kind of healthcare that's a little bit more insular and a little bit more defensive in the current market environment that we are in.
I agree with that. All right. Want to answer some questions?
Sure. I know we tried to answer as many questions as possible as we went along, but let's take a look.
I saw a couple. How do you feel about inverse ETFs? Go ahead.
Go ahead. No, you go ahead.
I have a lot of thoughts on inverse ETFs. One, they are intended to be day traded. That is extremely important. You have to know the product component and what is comprised of that ETF. A lot of times they are futures based, which means if you hold them long term, you will not be profitable, even if it seems that way. So I think that's the important part. But as far as just trading swings and day trading, sure, that's absolutely great. But they're inherent of a lot of risks. That's really my thought on inverse ETFs.
Yeah, go and read those perspectives. They're only providing you with the inverse for over a single trading day. So over a period of time, they're not going to give you that same inverse relationship. I think you're better off buying the put option, and just keep in mind that the cost of carry to hold on to a short position is built into that inverse ETF. So it's not going to give you a one-for-one inverse relationship within that trading day. Within the trading day, you do get a pure one-for-one inverse relationship or a pure leverage inverse relationship. But over a period of time, the cost of carry of that of that short is accounted for into the value of that ETF.
Mm-hmm. And it's elevated when it's leveraged. And that's increased risk. It's not one for one and only for the day. I think that's a great explanation.
Please define the wheel strategy. So Wesley, I think that the best thing to do is head over to our YouTube channel. Jess has hosted a fantastic session describing the wheel strategy, but essentially what you're doing is you're selling a put option to acquire shares. And once you've acquired those shares, you sell cover calls until the stock gets called away. And then you take the cash that you get from selling the stock back into a new put option that you sell. And by doing that over and over again, that's what we refer to as the wheel strategy. And OptionsPlay has a bunch of reports available to you within our education hub that you can find at the upper right-hand corner where it says education and resources for helping you implement this strategies. Our cover call and short put reports are to helps you find puts to sell to acquire stocks, and then the cover call report helps you sell those stocks potentially at a profit by selling cover calls against it. So a lot of different tools that Jess shows you during that session. I highly recommend you to watch it if you are interested in the the wheel strategy.
Mhm. Tony, you did give that session with me as well. You went through a lot of great tools.
I was there.
Yeah.
Amita saying, do you use high implied volatility options in the trade panel when IV rank is over 50? As a general rule of thumb, yes. When IV rank is over 50, we tend to at least start our research looking at these high implied volatility strategies. When IV rank is very low in the 10, 15 range, that's when we tend to start our research in bullish and bearish. But in any other in the middle, right, you tend to have both are possibilities. It really just depends on where you get kind of the better risk reward. And that comes down to skew of the difference between at the money and out of the money options. I'm not going to get into all of that, but there's no way to tell that until you really look at it.
Mm-hmm. And this recording will be available via YouTube and on our website. We'll actually send out a link to you shortly after this session if you want to watch the recording.
Yep. Any other questions? I know we covered a lot of them as we kind of went along.
Yeah. Only other one I see how you trade the VIX, the ticker symbol. It's VIX, but some firms have it different. So it may be a dollar sign in front of it or a dot. Just know it's however you see an index quoted somewhere, just utilize that same methodology. I think we did answer most of them. Go ahead.
Yeah. Well, this was a fun session for us. I hope that you as viewers got a lot out of this. This is obviously a different format, but this is a format that Jess and I are going to be moving towards more often so that we can talk about more relevant things that's happening in the markets and discuss trade ideas with you guys every single week, and present more opportunities and see and talk through why we have certain views in the market. It's really kind of an extended session from what we do on CNBC, but being able to actually talk you through our thought process as opposed to only having about that 90 seconds that we have to talk or pitch an idea, if you will, to you on TV. Here we can actually go into discussions, we can have a debate, we can really walk you through our thought process so that you can learn and find opportunities alongside with us. With that, thank you so much for your time this afternoon. I hope that you guys enjoyed this. Please send us your feedback to the customer service team. Let us know what you liked, what you didn't like. We will incorporate that into our feedback going forward. So Jess, thank you so much. This has been fun and looking forward to doing the next one with you.
Yeah, thanks, Tony. Have a great day, everyone.